Welcome back and welcome to Forex Minions. Today our topic of discussion is liquidity void, price imbalance and fair value gaps. As we in this complete series we are studying about the entry techniques, therefore to consider and learn about the liquidity void, price imbalance and fair value gap having great importance in Forex trading. By using these factors with other confluences, we can design our high probability sell and buy model. Let's study them in great details. When we do analysis in Forex market and we find out the actual trend by structure mapping. Now in the bullish market we want to buy and in the bearish market we want to sell. Here, every trades faces a problem that how to decide which buy or sell zone is valid. Now in this lecture we will study these logic to confirm a valid zone. Because every trader is watching the Forex market in his own perspective. But what logic exists behind that valid or invalid zone? By which theory or rules, or according to which principle our trading zones are high probability for buy and sell setups? We will study these rules in today's module. Secondly, when we find a completely valid zone, then question comes into mind that by using what price range or price levels, we can formulate our trade entry. For this purpose, we will study liquidity void, price imbalance and fair value gaps. When we talk about fair value gap, then very first question comes into mind, which fair value gap is valid? If you are a trader and you are trading in Forex market, then you have noticed that sometime market trigger your FVG entry zone and sometime not. Sometime market respect selected fair value gap and sometime market strongly reject this zone and move opposite to setup direction. Therefore price may hit your stop loss. Remember there is always a reason behind such things. Remember that, every fair value gap zone is not valid. Now, if a fair value gap zone is valid, then what are the confirmations rules and on which base that fair gap zone acts as a valid zone? We will study in details in today's module. Now, in Forex market the most common question is asked by those traders, who mostly struggle for success in Forex market that which buy and sell zone is their high probability zone. This is same question as we discussed in our previous slide. For every question that, which order block is valid? Which supply and demand zone is valid, and which fair value gap is high probability or valid? Remember, there is only one answer of these questions, and that is liquidity. In Forex market, answer of your all questions is liquidity. That's why, we will study liquidity sweep and liquidity grab prior to discuss the valid zones. Now we will talk about liquidity sweep and liquidity grab. Keep one thing in your mind that, there is only one objective of these two, which is liquidity sweep and liquidity grab. Their objective is to gain the liquidity which is market driving force. Market will gain liquidity for next movement, either it gain from the liquidity sweep or liquidity grab. Now we will study, both liquidity sweep and liquidity grab in parallel way for clear understanding. Let's start with liquidity sweep. Keep it in your mind that we have studied about liquidity sweep in previous lectures in details. If you are new to this channel, or just started following us, you can watch complete lecture on liquidity sweep in SMC first series. Here we will study only introduction about the liquidity sweep. Here, this is example of bearish market. Look at this point, market created this new high, this high just sweep the liquidity from previous high. We will call it the buy-side liquidity sweep. Here, the market maker trapping the buy-side traders who were waiting for upside breakout. Market sweep this liquidity and then changed its direction to the downside. Similarly, when we talk about bullish market, when market created this low, then this candle sweep the liquidity of previous low by candle Wyckoff and then move into another direction, which is bullish direction. So we call it as sell-side liquidity sweep. Now, if we see the buy-side liquidity sweep and sell-side liquidity sweep in the candlestick form, as we studied here, buy-side liquidity will be shown in this form, in which next candle will sweep the high of the previous candle. Similarly, when we talk about the sell-side liquidity sweep, the candlesticks will be shown in this form, where the next candle will sweep the low of its previous candle by its wick. Now, we will talk about the liquidity grab. Here is the candlestick chart and consider a bearish market. Now, if you note this range, what type of behavior is being shown by market? Well, here market is in consolidation phase, or we can say that market is ranging. When market is ranging, it's building liquidity on both sides. Eventually, it will give the break on either side of this range. Here, market showed a breakout on upper side, candle body closed above this consolidation phase. Here all the breakout traders and less informed traders, who has less knowledge, they consider it the valid breakout and they will start looking to buy in this zone. In such conditions, market grabs the liquidity and then moves into the opposite side of consolidation and this close on the lower side. This mostly happens when trend is bearish. And remember, this move must be in speed or expansion form. Only then we will consider it liquidity grab. At this point, where the market closed the candle on above side, this is only because of the liquidity grab and we will call it F buy side liquidity grab. In such cases, markets creates more and more liquidity, and trap more traders and move into the opposite side. Similarly, if we talk about the bullish market here, check this range. This is the phase where market is in consolidation phase. Again, market will consolidate just to build liquidity. When market will create enough liquidity on both sides, then market will give the break on lower side of this range. Candle body closed below this consolidation phase, keeping in mind bullish trend, the breakout traders and less informed traders, who has less knowledge of trend and market phase, they will consider it the breakout to the downside and they will start looking to sell in this zone. In such conditions, market grabs the liquidity and then moves into the opposite side of consolidation, and this close on the above side as trend is bullish. This mostly happens when trend is buy trend. In buy or bullish trend, market will grab liquidity from lower side and then move into original direction. Always remember, this move must be in speed or expansion form. Only then we will consider it liquidity grab. Hopefully now you have the clear understanding of liquidity sweep and liquidity grab, but both have the same objective, which is to gain liquidity to drive the Forex market. Now, we will talk about price imbalance or liquidity void. What is difference between liquidity void and price imbalance? What are its purpose, its role, and objective of this price imbalance? Remember, price imbalance is also known as liquidity void. We will study its reason shortly. Well, liquidity void or price imbalance is an area where price moves sharply in one direction. This is the area where we have an incomplete auction of buyers and sellers. Incomplete auction means, there will be pending orders and those pending orders create liquidity. There are pending orders to be filled within the price imbalance or void. That's why price imbalance is also known as liquidity void, because this is area of liquidity for buyers and sellers to transact and complete their orders. As market need liquidity for its next move, on this basis when market comes into the imbalance zone or liquidity void zone, then on the base of this liquidity void, we can design our sell or buy model. Hopefully now you have clear understanding of what price imbalance is, and why we call it liquidity void. And why it is the area of interest for us to trade. Now, how the liquidity voids and price imbalance looks like, let's discuss it schematically. Here, market move from this candle to this candle very sharply in one side. Now if we start noticing from this candle wick to this candle wick, this one side move is price imbalance or liquidity void. Similarly, these are two candles and if market makes three candles then? Well, number of candles doesn't matter, we will notice only that area or zone, where the market moves very fast in one-sided direction, that zone is simply known as liquidity void or price imbalance. Now, if we study same model for bullish market, when market moves sharply upward, here again that zone where market move one-sided to the buy side, this zone is also known as liquidity void or price imbalance. Similarly, number of candles have no effect, either it's two candles or three or more candles, but there must be one-sided movement of market, only then we will call it price imbalance. Hopefully now you have clear understanding of price imbalance and liquidity void, and why we use these areas to enter into market. Here is real market sample size. This is the bearish market, and here, market did very sharp one-sided movement. We will market this one-sided sharp movement as liquidity void or price imbalance. Now remember one thing, where there is price imbalance or liquidity void, market will fill this void in future. But when market gonna come back to balance this zone? Or you can say when market will come back to fill this void? Maybe after 1 hour, 1 week, or 1 month. Remember there is no time limit for these pending transactions, but remember, market will fill them for sure in future. Either market come to fill immediately or after 1 day, 2 day, 1 week, or after 1 month. Wherever market leaves a liquidity void, market will come back to fill it in future. Secondly, remember price can fill 100% of this liquidity void or price imbalance. For entry, we can target minimum 50% of the liquidity void or price imbalance. Here, we will divide this liquidity into parts to find out 50% zones. You can use Fibonacci tool to find our 50% level. Now if we notice price reaction, check that how beautifully price came back into this liquidity void zone, filled it and moved into trend direction. Let's check out another example. Here. This is another real market sample. This market is in bullish trend. One thing keep in your mind for the liquidity void or price imbalance is that, the liquidity void zone or price imbalance zone in the direction of the trend that will be more effective. But, if there is a price imbalance or liquidity void against the trend, then it will be not high probability zone. You can check this zone. Well, as this trend is bullish, and when market move to the upside direction sharply, their market create a liquidity void or price imbalance. Then market come back and fill that zone and then move sharply upward once again. Here, when market again moved sharply, it created liquidity void or price imbalance, and then again market fill the liquidity void and again moved sharply upward by creating again a price imbalance or liquidity void. And then market comes back fill that zone and the move towards its original direction. That's why if the liquidity void or price imbalance is according to the trend, market will give it more importance and we will consider high probability. Now, let's discuss the topic of fair value gap, which is also known as FVG. Fair value gap is refined form of liquidity void or price imbalance. Fair value gap is an area where price moves sharply in one direction, leaving pending orders behind as liquidity. We will measure the fair value gap from candles wick to wick. Let's understand this point by a diagram. This is a diagram of liquidity void. If we transpose it here to find fair value gap zones, then you must note this area. Notice that this wick to wick gap is fair value gap. Similarly, this wick to wick gap is also FVG zone. Now, let's understand it for bullish sample size. If we check this liquidity void, and refine it to fair value gaps, then this wick to wick distance or gap will be considered as fair value gap. Similarly, here is another fair value gap zone. Remember, for bullish trend, buy side fair value gaps will be high probability. For bearish trend, sell side fair value gaps will be high probability. Now question is how to trade a fair value gap zone? It's preferable to trade FVG zone after an inducement or FTR level, FTR mean failed to reach. Now question is, how to find a valid fair value gap zone? Or you can say that how to avoid an invalid fair value gap zone. Well, there are two basic rules for fair value gap confirmation. First, for sell trend, we will draw fair value gap from highest candle wick. Secondly, remember to find a fair value gap in a pullback, it must be valid pullback. Let's check these examples to understand these rules. This first one is very basic and simple diagram. Here if you note this fair value gap zone, this one is valid. Because this fair value gap is drawn from this highest candle wick. Similarly, if we check out this fair value gap zone, is it valid or not? Well, this is also valid. Because if a swing has highest candle, then there available all fair value gap zones will be valid. Let's check out this another simple example. If we mark this fair value gap zone, is this valid? Answer is yes, because this swing has highest candle at start of it. So this is our valid zone. Now, here are two diagrams and I would like to ask you, which one is valid fair value gap zone? Study these rules and write your answer in comment section, either A is valid zone or B zone. Stop this screen for a moment and answer it. Well, the correct answer is, A is invalid fair value gap zone. Because this zone is framed from this bullish candle, which is not highest candle, that's why this is invalid zone. Here, this fair value gap zone will be valid, because this is marked from highest candle's wick. Similarly, B is also a valid fair value gap. Because in this sample size, bullish candle is highest candle and we marked this zone from its wick. Similarly, this fair value gap zone is also valid zone. Now, to understand a fair value gap in pullback situations, here is a sample size. We can notice that, this is a fair value gap zone. Now, this one is also a valid zone. Because this bullish candle is highest candle, as this candle sweep the liquidity from previous high. That's why, to mark a fair value gap in pullback zone, we always check either pullback is valid or not. Only then we can mark a valid fair value gap. Now, what about this fair value gap zone? Is it valid or not? Well, this is also valid fair value gap because this bearish candle is highest candle, as per our rules. Now, here you can see these four diagrams. Can you answer that which one is valid fair value gap zone and which is not valid? Pause this video for a while, post your answers in comment section. Well, let me answer it for you. Here, C is not valid fair value gap zone. Because the wick we used, is not the highest candle's wick. Here, this first one candle is highest candle. You can check it by these horizontal lines. Similarly, D is also not valid. Reason is same as discussed earlier. This is not marked from highest candle's wick. The first one bearish candle is highest candle here. If you notice E diagram, this is also invalid fair value gap zone. Reason as discussed earlier. Well, if we check F sample size, this fair value gap is valid. Because this is marked from highest candle's wick. Let's check out more examples for more understanding. Now, here you can see these two examples. Evaluate yourself and assure that which one is valid fair value gap zone? Either G or H. Well, G is not valid fair value gap zone. Because the selected candle was not highest candle. Hope it makes sense and concept it clear to you now. Well, if we use the sample size to find correct fair value gap zone, as shown in H diagram. Here, H is valid fair value gap zone. Because this was our highest candle and we marked this fair value gap zone from its wick. Now, let's check these samples. If we talk about this I sample size, is it valid or not? No, this is not valid. Because as per our rules, this marked zone is not selected from highest candle. Notice that? Well, if we select this diagram again, then you ask me which one is valid zone? Then you need to notice this zone, which is marked from this highest candle's wick. This K zone is valid fair value gap zone as per our rules. I hope these rules are much clear now and you are able to mark a valid fair value gap zone now. Now finally, a question comes into mind that how we can trade a valid fair value gap zone? Well, first most important thing is, fair value gap must be traded in trend direction. Always trade any FVG after liquidity sweep or liquidity grab. And finally, fair value gap zone coupled with order block or supply and demand is highly probability. Now, If we check valid or invalid fair value gap zones for bullish market, then these rules will be 100% with only one difference. To find a valid fair value gap zone in bullish side, we will use these two rules. First, for buy trend, we will draw fair value gap from lowest candle wick. Secondly, remember to find a fair value gap in a pullback, it must be valid pullback. These are 100% same inverted examples. You can check these valid fair value gaps, these are marked from lowest candle's wick. You can check these samples one by one as an assignment. Similarly, these invalid fair value gaps are marked from invalid candle choice. These were not lowest candles to mark a valid fair value zone. Remember, to mark a valid fair value gap in bullish market, always select it from lowest candle's wick. Here is another example for your understanding. I hope these rules are much clear now and you are able to mark a valid fair value gap zone now. Now finally, a question comes into mind that how we can trade a valid fair value gap zone in bullish market? Well, first most important thing is, fair value gap must be traded in bullish trend direction. Always trade any fair value gap after liquidity sweep or liquidity grab. And finally, fair value gap zone coupled with order block or supply and demand is highly probability. Now, let's observe this real market sample size. This is a bearish market sample size. If you note this zone, this is a valid fair value gap. Notice that how price came back into this zone, and filled this small liquidity void, or you can say, fair value gap. Price rejected from this zone and followed the major trend nicely. Remember this, market always respect trend-based fair value gaps, I mean FVG zones in trend direction. Again, notice this zone. This fair value gap also holding this price and rejected it strongly. Because this fair value gap zone is in trend's direction, and such zones are high probability as discussed earlier. Finally, remember, we will use 50% of this fair value gap zones to formulate our trade entry. I hope this lecture will be an eye-opener for you. Now I expect you can easily mark a valid fair value gap zone after a little practice. Now, if you have any question, you can drop us an email. Or you can scan this QR code to contact us on our social platforms. Until next lecture, wish you good luck and happy trading.